The idea that Trump's secret weapon isn't tariffs, but the demolition of the Federal Reserve is an attention grabbing thesis, but it's more speculative narrative than a realistic near term scenario. Let's break it down piece by piece. 1. The Fed is far from irrelevant. For now. The Federal Reserve remains the single most powerful central bank in the world. Its monetary policy sets the tone for global capital flows, risk appetite, and the cost of money. It controls the world's reserve currency, and its balance sheet is still over $7 trillion. While there's real criticism about its effectiveness, particularly after the 2008 crisis and the COVID stimulus, it's not going away tomorrow. It's deeply embedded in the US financial system's plumbing, payment rails, bank reserves, repo markets, dollar liquidity. 2. The blockchain vision has merit, but is incomplete. Yes, there is an emerging parallel system being built. Stablecoins, Bitcoin, DeFi protocols, central bank digital currencies, CBDCs. But they're nowhere near ready to fully replace the Fed's core functions: setting rates, lender of last resort capacity, systemic oversight. Private crypto networks can compete at the margin, especially for cross border payments or store value use cases, but monetary sovereignty is still guarded jealously by governments, especially the US, whose power partly depends on dollar hegemony. 3. Tariffs as a funding mechanism for this? This is where the theory stretches credulity. Tariffs are a tax on imports that can raise government revenue, but they're tiny compared to what's needed to overhaul an entire monetary regime, and they're economically distortionary. So the idea that they're secretly funding a pivot to a crypto backed monetary system feels more like a plot twist than a practical plan. 4. Political reality check. Abolishing or neutering the Fed would require Congress, a monumental legal fight, and massive market fallout. Markets would likely see it as an existential threat to financial stability. Politically, most Americans don't want a monetary free for all. They want predictable mortgages, stable banks, and some sense that someone can step in when things break. Bottom line, the Fed could lose influence over time if decentralized money matures and public trust shifts decisively. But that's a generational trend, not an overnight demolition. So, this vision is an interesting what if, a good headline, but not a short term probability. It does raise a valid point, though. The real disruption of the Fed won't come from inside Washington. It'll come from technology, shifting trust, and private alternatives that quietly chip away at its monopoly. That's worth watching, but demolition, not yet. Let's unpack how a Fedless system could actually look, what would have to happen for it to work, and what the real obstacles are. Key number 1. What does the Fed actually do that must be replaced? To demolish the Fed means replacing these core functions. A. Monetary policy. It sets interest rates to control inflation and growth. It manages liquidity through open market operations. B. Lender of last resort. It provides emergency liquidity to banks in a crisis, like 2008 or 2020. C. Payment infrastructure. It clears huge volumes of transactions daily. It supports interbank settlement and the dollar as global reserve currency. D. Confidence anchor. It provides some degree of predictability and backstop for the US banking system. If you kill the Fed, something must handle these, or the entire banking and payment system risks collapse or fragmentation. Number 2. What would replace these roles? A. Decentralized monetary policy. Some stablecoins, like MakerDAO's DAI, use algorithmic mechanisms to adjust supply and maintain a peg. In theory, you could have a decentralized system with supply and demand signals replacing a central rate setting committee. Problem: it's extremely fragile during crises. Algorithms can't backstop bank runs or sudden liquidity shocks like humans can. B. Lender of last resort. Bitcoin and DeFi don't have a lender of last resort. If confidence collapses, there's no emergency backstop. One workaround might be algorithmic insurance funds or large decentralized treasuries, but these haven't scaled to a level remotely comparable to the Fed's firepower. C. Payments. Stablecoins, crypto rails, and tokenized bank deposits can settle instantly, 24/7, globally. The technology can be superior to FedWire or ACH, but scaling this to every US business, household, and government payment is a massive lift. Regulatory alignment, consumer trust, legal tender laws. D. Confidence anchor. Crypto's core promise is trust the math, not humans. But in practice, people still want human accountability when things go wrong. Many decentralized systems ironically re centralize when under stress. See stablecoin depegs or exchange bailouts. Number three, how might a realistic transition actually happen? The plausible path isn't a sudden demolition, it's gradual erosion. Possible steps? Number one, parallel system. More private money, USDC, PayPal stablecoins, tokenized bank deposits, grows in usage for payments, cross border trade, and savings. Number two, CBDCs. The government might roll out its own digital dollar, ironically preserving the Fed's role by modernizing it, not killing it. Number three, less centralized control. If Congress or a populist administration really wants to curb the Fed's power, they might tie its hands, e.g., strict policy rules, gold backed currencies, or more fiscal dominance. Government spending and taxes drive the economy more than rates do. Number four, public adoption. People must want to use an alternative money system. That means trust, usability, and widespread merchant acceptance, not just speculation on crypto exchanges. Number five, major crisis. Sometimes it takes a shock, hyperinflation, a political crisis, or a collapse in dollar confidence to force radical monetary reform. But the US dollar is still the global reserve currency because the alternatives, euro, yuan, Bitcoin, all have huge flaws too. So is this future possible? Yes, but it's more plausible as a weakening of the Fed's influence at the margins, a gradual shift toward private and decentralized money coexisting with fiat, a hybrid system. Central banks remain but lose some monopoly power over payments and even store of value functions. Bottom line, the Fedless world is technically imaginable, but not because one president swings a wrecking ball. It would be a result of technological breakthroughs, scalable, secure, user friendly crypto rails, public trust in new money that isn't government issued, and a catalyst crisis that breaks confidence in the dollar or the Fed policy. All of which means if you're betting on this future, you're betting on tech, trust, and disruption over decades, not on tariffs or a single administration.